Good morning. Today is Thursday, May 18th, and this is Capital Discussions. It's a special roundtable because of the large sell-off that we had yesterday. I'd ask everybody to mute yourself if you're not asking a question. Quick disclaimer before we get started. Capital Discussions is not a broker-dealer or an investment advisor. The presentation you're about to see is for educational purposes only. We have no way of knowing what level of risk is appropriate for you. We're not making any trade recommendations. The risk of trading options can be substantial. Please be aware of all risk prior to placing any trades. Any trades that we talk about, computer simulated trades, are believed to be accurate. However, due to such factors as liquidity, slippage, and commissions, your profit and loss will vary. We had an exciting day yesterday, didn't we, guys? What I'll end up doing, the way I'd like to end up running this is that I'd like to take a few minutes just to kind of go through the market, where we are from a technical analysis point of view, so that we have a frame of reference. Then I'll end up talking about any trades that you end up liking, that you want to speak about, any trades that may be having problems. Also, a lot of folks had asked me questions in and around how implied volatility and skew ends up affecting prices. I think you got a pretty good example of the change in volatility yesterday, with the VIX being up nearly 40%. And so we'll take a look at some of those factors, probably taking about 10, 15 minutes just to get through the technical analysis, and then we'll open it up to a conversation. Okay, what I do, and I do this, by the way, every Monday morning on my Monday Market News. I basically go through technical analysis of where the markets are in the first part of the presentation, and I'll do an abbreviated version of that so we can just take a look at what's happened recently. The way I end up having my long-term SPX chart, you can see that here, is that I have long-term trend lines in aqua that are moving up, shorter-term trend lines that are moving up in this magenta, downward trend lines in red. So if I take a look, I'll just show you over the last couple of years, any specific price levels that I think are very significant, I'll end up tagging them in yellow coming across. One of the things that you can end up seeing here, and we're going to start from, well, I'll start from this point here. This was Brexit. We ended up gapping up on this. This was the U.S. election. We actually didn't have a real gap on it. And basically, this has been the rally that we've had since. So I want to end up putting things in perspective. From the election, when we were fearful, okay, that Trump might end up winning, we were down here. Now, when we're fearful that we're going to lose him, okay, we're selling off here. Okay, so just realize where we are in the bigger picture and what can end up happening. One of the things I want to end up highlighting was that we had a series of obviously higher highs and higher lows. It wasn't until we ended up getting to this point when we had the blow-off top back on March 1st, the blow-off top meaning that we had this huge gap, which is filled. And then we had a series of lower lows, and I'll get into that. But there was a trend line that was moving downward right here. And let's highlight this area so it's easier to see. So we had this trend line that was moving down. And we had this huge gap a couple of weeks ago over the weekend. When the markets opened up on the 24th, this was the French presidential elections. We ended up moving up. Usually after gaps like this, especially gaps that were so important, right? This was an absolutely hugely important gap because it, and I'll show you on the next chart, it passed the 20-day, the 50-day moving average. It broke through this downward trend line, and we cleared it in the single bound. And then the next day, we gapped again. Those who've been watching the Monday Market News, I will tell you that gaps almost always fill. Yes, some people will end up saying, well, Jim, these gaps didn't fill over here. This is a great example of a gap that doesn't fill. It was this huge sell-off because of Brexit. Then we ended up realizing the world won't end just because the UK is not in the EU, and it won't end up meaning the end to civilization as we know it, which you would have thought was happening during the first 2 days. And we gapped right back up. So there wasn't a lot of traffic in this area. So I don't expect with the same degree of probability that gaps like this could end up filling.
The next bear market, Jim.
Next bear market, it'll fill. Okay.
Yes.
I was just going to type in it's not filled yet.
It's not filled yet. Okay. And you take a look at it. Can we get down to under 2,000? And yeah, we can, without question. I mean, it's only what a 15% pullback. And so, if we end up coming down in the next bear market, that's why I don't delete these gaps. It's why I don't delete price levels well below where we are, because in the next bear market, I mean, if you want to end up taking a look at this, I have some of these lines drawn back to the bottom that we hit in 2008. And do they come into play? They do. Take a look at for years, this was a support line. And when we had these big sell-offs, okay, they ended up breaking. They were either support and then they turned into resistance. But I don't like to end up deleting longer term lines unless they really don't come into play anymore. That's how come you see these three lines that were from the bottom of the financial crisis in 2009, okay, that are still here. Okay, so if we take a look at these two gaps, which, like I had mentioned, we talked about during the Monday Market Muse now at nauseum for the last 3 weeks, saying, that they usually fill. Well, guess what? Today, we filled it. Yesterday, we came within 3 cents of filling the lower gap. Today, we filled it completely. So in my next drawing, I will be deleting these gaps. However, yesterday, we left the gap above. Okay, there was this huge gap that we ended up having that was as sizable, actually it was slightly even larger than the French election gap, and we ended up selling off. Will that end up filling? I think definitely. When? I don't have a clue. I mean, it could fill in, next week, next month, and 10 years from now. But it will end up filling eventually, most probably. Okay, just as these gaps most probably would fill. It took them almost a month. Okay, but they got there. Okay, so that's where we are. Very interesting that this downward trend line, which had acted as resistance all along until we broke it, actually started to act as support. One of the things that we also ended up drawing a line was, if you come back over to here and you take a look at the 22, I don't have to go back that far. You take a look at a level like just above 2350. We had this line here that acted as resistance for 3 whole days before we gapped. We did end up gapping. When it came down, it ended up being support. That little tiny gap area that was in here got filled eventually. Okay, and the fact that we came back to a pretty significant level. And you can see that even when we had the huge sell-off, okay, on the 21st of March, which, by the way, was a bigger sell-off than we had yesterday. When we had that huge sell-off, okay, on that single day, you can see that 23, just above the 2350 area, acted as resistance. We got above it. It acted as support. We broke below it. And then when we finally ended up getting through this, now this is what made this day so significant. This was the close on Friday, right, 421. We gapped above that support line. We gapped above the downward trend line, and let me go to the following. I have another one that I use. Okay, here was the upward channel going back to the beginning of 2016. Okay, and you can see that quite clearly that we had this upward channel that was relatively well defined. What ended up happening, okay, this year when we ended up moving up, we ended up having what was known as a blow-off top. A blow-off top defined by Ned Davis, the research company that a lot of institutions used to end up using. I don't know if they're used as prevalently as they used to be, but they used to be quoted all the time. They do some really great research. I guess with computers now, so many other people are doing the type of research they did that they're not quoted as much. But a blow-off top was when you had a bull market for a period of time, and then you had a huge gap up. Other people may call these exhaustion gaps because the bulls are running, then they have this huge gap up. And it was the day that we ended up hitting our high, and yes, we broke it, okay, over the last several days here before we had the big sell-off. But gaps like this almost always fill. The Ned Davis research that, again, we quoted during the Monday Market Muse, went back to 1900. obviously the S&P wasn't around in 1900, so they used the Dow. And there was something like 21 exhaustion gaps in the last 17 years, all of which failed. Okay, all of which failed. And so they ended up clearly defining it. So this was the beginning of our downward trend. And we made lower highs and lower lows. And even this higher low was actually a lower closing low. And you can see that the green curved line here, and you can see that right up here, is the simple moving average for the 20-day, the simple moving average for the 50-day. So we broke through that 2350 support, that 2300, well, the downward trend we broke. The other thing we ended up breaking through was the support line that ended up holding up everything since the beginning of the year. If you take a look going back to the last trading day of last year, this was a pretty strong support line. Even when we broke through it and we ended up forming our lower low in the bottom of our channel here, we closed above it, right? Because the green candles mean that we went out at the top right-hand side. We came in at the lower left-hand side of the candle. So we ended up closing above it. So it acted as great support. Once we broke through it, okay, and it took a couple of days to get through it, right? We pierced it, but finished above it, went through it. This acted as clear resistance. Well, we just gapped straight through it. So there was all of these technical signs that we needed to end up pulling back, okay? And we finally have. And so I think, and I've been saying this again, okay, to my Kevlar subscribers and to the Vol Vantage guys and to the Monday Market News guys, that it would be very, very healthy for this market to end up having a pullback, at least cover these gaps, get back to a main support level. I saw that there would end up being, what I had said was, would the 2350 area hold? I didn't know, but I saw a lot of different support levels going down at 2350, 2325, and even a little bit lower than that. But you can see here the lows in this 2325 area was the bottom of this congestion area. If I go back further, I made that. I wanted to make it. There we go. I'm going in the right direction. You can see that this slow area over here, we did break through it, and then we ended up coming back. And so, again, I kind of took a look at 2350 to 2325 was going to be a more difficult area to pierce unless we had significant news that would end up driving us down. Now, I do want to, and I don't want this to end up being a political conversation, but I do want to end up at least making a comment about this. Because when I first heard it about possible impeachment, and, I kind of laughed at it when I first heard it because I'm like, this has been going on since the day after the election, right? I mean, in Hillary Clinton's concession speech the next day after the elections, she blamed the Russians. They've been blaming the Russians for everything. Okay, I know that Flynn ended up having problems, but I didn't see, and even in all this, I tried to end up watching the news like all night last night and the night before. I didn't see anything significantly in terms of actual proof. All they did is they're going to say they're going to end up investigating. Well, good. Let's get everything out in the open the way it should end up being. But I didn't see this as, anything. Now, it's very different if what the investigation turns up. So, again, this is potential bad news for the market. Now, why is it potential bad news for the market? Because let's go back to this evening, okay? The evening of the 14th, the 4th of November, right? This was election day. The futures sold off another 5 points. We hit lock limit down because every guru in the market basically pronounced that if Trump won, we were going to end up going down 5 to 10%, and we did overnight. Okay, we just happened to end up bouncing all the way back up by the time the markets opened. Regardless of your political views, the way the market interprets this, because that's all I care about, right, is how the market interprets this. It was what happened basically to everybody when we were lock limit down. They said, okay, no matter what your opinion is of our president, you can end up thinking he was a jerk, he did this, he did that. But if he's going to end up cutting taxes, okay, if he's going to end up doing more infrastructure spending, okay, the markets are going to like those types of reforms. If he can end up keeping healthcare costs, and I don't care, again, what your opinions are, the market ended up thinking, oh, healthcare costs will go down for the rest of the corporations in America, so therefore it's good for the market. Okay, I don't mean to think like a mercenary, but if you're going to be a trader, you're going to have to end up realizing this. Okay, we're all adults. Let me tell you the day that I realized it. I realized it in 1994. Okay, I was driving home. I had just started working at Pricewaterhouse. I was driving home from a client site late at night. Okay, it's maybe 11 o'clock at night, and there was a massive earthquake in Kobe, Japan. Okay, I had on Bloomberg News, and they talked. The initial news factor came out and said at least 100,000 people have died. Well over 1 million have lost their residence and everything they own. Okay, this could not be more horrific. Okay, that type of news that you could possibly think. Now they went to the movers in the market. Komatsu. For those who don't know Komatsu, Komatsu is basically the caterpillar of Japan. Komatsu was up 10%. And it was on that day that I said, I don't know how, because back then there weren't computers, they were actual traders. I don't know how a trader, what kind of person that could ever be, okay, in the sense that I just heard 100,000 people died, and if I hit buy on Komatsu quicker than you do, I make more money. How does that end up being not a thought process, but a reflex? Okay, well, fast forward now, 20 years, and we're actually not even thinking about it anymore because the computers do it. Okay, so I don't want you to end up becoming totally insensitive, but you have your portfolio to end up worrying about. You have your financial future to end up worrying about, and you have to end up thinking sometimes, what does this end up meaning to the market? Okay, sorry for the aside, but I think it's really important that we at least have an understanding of where we are and what the markets are doing. Okay, so when I end up seeing this type of sell-off, okay, where we've now gone through, and by the way, we gapped through the 20-day moving average yet again, left another gap above. We came down. That downward trend line is obviously support. The upward support line, right? This trend line that was support that we gapped above it. Well, guess what? We just gapped below it again. And so we kind of seem that at least temporarily right now, we found some type of support. One of the things that had happened very clearly, and we had been talking about this for weeks, again on the Monday Market Muse, is that when you take a look at this pattern right in here, if you take a look along the top, you see the yellow line, okay, that had been the top of the pattern. You see the bottom support line, and you see how it's getting tighter and tighter and tighter. What we talked about is that when you have a flag pattern like this, okay, it's kind of like compressing a spring, that it gets compressed and compressed and compressed. And when it releases big. Now, when we were talking about this, because of the resistance that we had here in the buying, the probabilities were, okay, if you go back and you do all your technical analysis, when you end up having a pattern like this, a flat line on the top and an increasing support line on the bottom, as you end up getting through this line, as you compress it, if you break through the bottom, you can normally have a pretty significant line, a jump down, which we did, okay? And so the fact that we've come down to here, we've at least temporarily, okay, we don't know what's going to happen tomorrow, but we found support. It was it was a good level of support. This 2350 area, or just above 2350, was a very strong level where I would have expected the bulls to step in, and they have. However, they've stepped in right now, and although we're up, okay, if you are, and I know Paul's looking at this on the minute charts, um, if you look at the buying that's happened over the last 15 minutes, it's slowed down. It's slowed down. Are we peaking right now and going for another leg down? If we do start to end up going down, this is the first time during the day, basically, within the last 5-10 minutes, is the first time where we're finding that. And I can end up showing you that here. Okay, let's just highlight this. Okay, so you can end up seeing that the buys that we had been moving up here, and what's happened is that the volume in this area, right, over the last 10-15 minutes has come down a little bit. We've moved sideways. Will there be more buying to come in? I don't know. Right now, this fact that you were pushed up and your upward bars have more volume than your downward bars is a bullish sign. A lot of times I talk about elephant footprints, and what I mean by that is that if they're going to be large institutions, high frequency trading firms, algo shops, okay, guys that are going to end up moving a tremendous amount of volume, they're going to end up doing this, and they can't hide their volume, right? Because they're going to trade in big size. Just the way, an elephant can't hide its footprints, okay? Too big, it makes too big of an indentation. Take a look at what the bars look like. The other thing that's happened is that if you take a look at the VIX futures, we did end up hitting a high overnight, okay, even more so. And you can see, let me line up the chart so you can actually see them. Okay, not perfectly lined up, but maybe like that. Maybe like that, okay. So when we ended up having this sell-off, it was off to the races again with the VIX futures, okay? And so the fact that the VIX futures, more so than the VIX itself, will end up giving you a better feel for what's going on. Remember, the VIX, okay, is a calculated index. It's given to you for what people are willing to end up paying for different options. Sometimes the flow of options may or may not influence the VIX. For example, the VIX is a 30-day, okay, look forward. So it has an average of a 30-day expiration. Several years ago, they changed it. It only used to be the monthlies that they ended up calculating. Now they end up using the weeklies. But if you end up using or buying puts in one of the expirations that the VIX is not calculated in, or if you buy them further enough away from the money, which the VIX has a smaller or even no impact at all on the VIX because it's outside of the range of the calculations, you're not going to end up seeing that. Remember, the VIX futures are the most traded indice, okay, at least by commissions, of any, and hence volume, of any index in the high frequency algo world. Okay, so this is the one that's going to end up moving very quickly. The other thing that I end up looking at all the time is not just the front month VIX, but how does the front month compare to the second and third months? And so if I take a look at my VIX term structure, and let me just take you back a little. This noise over here was pre-election, pre-French election. By the way, why do these things keep happening on expirations? Okay, this happened on the expiration of the normal markets, meaning the S&P and all the stocks, not on the VIX futures. This movement happened right here, and you can see it, by the way, by the blue line. The way what you're looking at is you can see the days on the bottom. You're looking at a 15-minute chart. The price is on the right, And each of these represents the VIX futures. I tried to end up emulating the best I could the colors of the spectrum, starting with this violet or this blue, okay, being the futures that just expired on Wednesday. Okay, they expired, and the ones that expired were the Mays. So these are the Mays. The aqua color are the Junes, then the Julys, the August, the Septembers, and so on. When we had this big sell-off, did the term structure change significantly? Yes, everything jumped up huge, but this was not we're fearful of something that's going to end up happening tomorrow, right? Because it's not. All they ended up announcing was they announced, okay, that there's going to be a special prosecutor, and we're not going to end up getting any information for probably at least months, right? The investigation's going to end up going on. This is going to end up being political grandstanding that basically has been going on since the day after the election. And so what will end up happening, we won't know for a while. So I've told you guys this, okay? There's no guarantees on Wall Street. Everybody else has it. There's one, in my opinion. The markets will overreact, okay? They'll overreact. Was the initial sell-off yesterday an overreaction? Probably. What happens if new facts, okay, come out, okay, that end up showing actual collusion? Then they've underreacted. Then we'll overreact again, okay? But there'll be a much, much bigger leg down at that point. One of the things that you guys have to realize, and this is so critical, in the world that we live in today, that is driven by high-frequency traders and algos, these types of very, very, very sharp moves, okay, will end up happening, okay? They'll end up happening, and that's why, or one of the reasons why, the high frequency and the algo guys drive the implied volatility from below the money, meaning the put skew, the IV of the puts below the money. It's why they drive that higher, okay? It's one of the reasons. And so that's what we see. I don't have my live vol open, and if I do, I think I might slow up too much. But that was basically what I wanted to end up presenting. What I'd like to end up doing is I'd like to end up opening it up if there are specific types of trades that you want to end up say, well, Jim, how does this affect this trade, or how does it affect that trade? I'd be more than happy to end up going through any or all of them. Okay. You can either, if you want to end up signing on and discussing it, we can, or if you want to end up writing it.
Hi, Jim.
Paul, how have you been?
Not bad. I have one comment to make about impeachment. Overnight, Brazil, they discovered that their president did something really bad, and they have filed impeachment proceedings against him. So
the market
kind of, yeah. Their stock market opened up down 11%. So we need to be careful what we wish for.
Right. Okay. I can tell you, I was listening to Bloomberg, and this leg down right here. Let me highlight what had happened. This is the lows that we hit overnight. This is when I heard it on Bloomberg, right, in their 8 o'clock news. Okay, and that's what happened right afterwards. Okay, and yes, I heard. I haven't followed it. I don't know what the Brazilian market's done since.
It's down 9.9%, and the real, their currency, has hit. The real, I think.
Real.
Sorry. Has hit lock limit down twice.
Yeah.
After what happened with the Clinton impeachment, I doubt Congress has the stomach to
do anything
again unless there is something really outrageous.
Right. This is just baloney.
It was funny.
The problem is the market reacts to the baloney, so you have to factor that in when you're, doesn't matter if you're for or against or what part, none of it matters. What matters is what news drives the market and will drive the market. So, I don't particularly care one way or another. I think they're all useless. So I just thought I'd bring that up. That what we saw yesterday was nothing. I think the people trading in Brazil right now would be very grateful today to see a 2% down move instead of what they're trying to deal with.
Yeah, I mean, yesterday didn't seem to phase the Vix Futures in the sense that they stayed solidly in contango.
Right.
Correct. They did.
That's what I brought in, and not just the front month, right? That wasn't just the front month contango. That's what I was showing here. Okay, when you take a look at and I highlight what happened just over the last couple of days, right? We stayed solidly in contango all the way through. Okay, we never broke our contango. By the way, for those of you who don't know what we're talking about, what contango means in the futures, and we're talking specifically about the VIX futures, it means that the shorter term futures trade below the longer term futures. So when people talk about contango, mostly, the default is the difference between the first 2 months. One of the things that I end up doing in VolVantage, I realized, hey, you can't look at just the first 2 months. Sometimes there are really great hints in the longer term futures, right? It makes sense. It actually proves out to be true also. When you take a look at what ended up happening with all of the VIX futures, none of the VIX futures for the first 6 months, were in backwardation. Backwardation, it would be when the shorter term VIX futures or any future moves above the longer term one. The fact that this ended up happening on expiration of the VIX futures was a coincidence, I guess. Unless you're really big. unless you're a conspiracy theorist like Paul.
Nothing is a coincidence.
One of the things that I ended up having is that I ended up with some of my stuff when I prepared for the downside, right? I prepared for the downside, and if you took a look at the tape here, and you took a look at the 1 minute tape of both the VIX futures and the E-minis, what you would end up finding is that on this day, and let me go over to, let me bring up that one again. And let's just look at just the VIX.
You now have a nice island bottom in the VIX, too.
Yeah, you do. You do. Okay. And let me come over to here. I don't need this. Let me put that over there. Okay. So here's what I was talking about on this day. Oh, no, I'm sorry. The day before. I need to go back 2 days. So let me come back. And I'll just do a 5-minute chart because that'll be significant enough. Okay. So here's what I wanted you to see. Okay. I want you to end up looking at the selling pressure that we ended up having and how big the bars are on most of the down bars versus the up bars. When you end up taking a look at even when the bulls came in and tried to run things up, in the last few minutes of the market, and remember this closes this is the closing bar, this highest bar here. Even when they came in, with a huge amount of volume, they were barely able to end up budging it up. We still closed lower than most of the day without anything, and then we started to drift down. This was when the market closed. When we reopened, the news had already hit, and so the elephant footprints. And the same was true in other things. If I take a look at the VIX, the elephant footprint said, "Hey, this was negative." Now, did it say that anything was going to end up happening with the announcement at 5 o'clock in the afternoon? No, it didn't. But if you believe that you get your news as fast as the high frequency guys that are willing to pay, millions and millions of dollars a month to be able to get stuff quicker, you're being a bit naive. Did anybody know? Well, somebody had to know. How much did that end up affecting the market? I don't know. I just know that the elephant footprints are here that end up saying, hey, when you have big selling pressure, on down days, and even if you take a look at the move up, right? This move up, it was on a much smaller volume. And I'm looking at a 5-minute chart. When you look at a 1-minute chart, it even becomes clearer. And so, yeah, um, I don't know. I didn't want to say with much ado about nothing because you don't know what the investigation will actually end up bringing. But like I said, I don't think that regardless of your political views, and I want you to, and sometimes I know that's hard. Um, it's not difficult for me. I've been an independent all my life, and I voted on both sides of the tickets. Um, I end up taking a look at what does this mean for the market? What does it mean for the market? And it appears it had been overdone.
You know, it's my opinion. You know, the market does not like uncertainty.
Mm-hmm.
Doesn't matter what kind of uncertainty, it just doesn't like it. So they like everything all laid out. We understand exactly what's going on, and we can plan for the future. Um, so, you know, I think some of this might have been because, oh, now we have no idea what's going to happen. So let's take some money off the table. So we just have to go forward and see if this has any follow through or if this was a one-day event. I will say this: a long, long time ago, somebody made the comment to me that nothing good happens under the 50-day moving average. So I'm all hedged up.
This is very, very true. Very, very true.
I found it interesting yesterday, you know, watching the skew uh, graph, that um, naturally the skew for yesterday went up quite a bit. It was very dramatic. What I did notice was the steepness never changed.
Paul, you and I didn't speak about that, but I was on the phone with the EAB guys, and that was kind of very interesting. Okay. Um, what that ends up meaning, okay, to the layperson is that the longer term fear of something really, really, really ugly happening isn't here yet. Okay.
Right.
It says that we're really fearful that the market might drop, even though we dropped 2% in the S&P. We're not so fearful about this. We're still fearful about another, 5 or 10% drop on top of this. So all they announced was that they're going to investigate. Now, as facts come out during the investigation, if things become um, more evident, if there's more evidence presented that collusion did end up happening, you're in for a wild ride. You're in for an absolute wild ride. It's going to end up getting even much, 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 much worse than today, okay, or yesterday. So, here's my bottom line conclusions. Yesterday appeared to be overdone. However, if the potential fears for what drove the market down end up becoming realized, you ain't seen nothing yet.
Well, it's funny. I go back and look at the history on the skews and trying to figure out, because I'm trying to figure out what the heck's going on with them. But what I'm finding is now is the steepness when we have down moves and the, spike ups and volatility, that it takes, we need to be going down for like 2 or 3 days before that thing is going to start flattening out like it used to right away. So it's like they're holding back making the decision of changing the skews. Not that I'm a conspiracy theorist or anything.
No, but that's true. One of the things that ends up happening, and there are two parts to it, is that I think it's within the skew tells you a lot more than definitely more than the VIX, more than the VIX front month futures. The VIX futures term structure starts to tell you some. I think that the two biggest things to end up telling you how much more selling is going to be happening is the term structure of the VIX and the VIX skews. And so, Paul, what I'll end up showing is that I had brought this up over here. Okay. And if I end up coming back, what I want to, and I'll go back a couple of days so that you can actually just see what ended up happening over the last several days. Okay. I'm going to go back to the 12th. So what you're looking at here is that each of the colors that I've highlighted in white, okay, are lines that are drawn here. So you can end up seeing that the May expiration, which is this Friday, and we're going back to the 12th, is in red. Okay, you can then end up seeing that the next month, okay, which is the June's, is in this orange, and so on. And so when we talk about skew, okay, what we're talking about is that the implied volatility of the puts below the money, okay, where they stand compared to the puts at the money or above the money. This area 1 month out, and you can also see 1 week out, has the same type of thing. It ends up having a low somewhere above the money. As expiration gets closer, this area that Paul has named the belly of the curve, and I've been using constantly since I heard it, is further away from the money when you have more time left to go, and you can end up seeing that, like, for example, if I go out to September, which is the white line, we haven't even gotten to the belly of the curve yet, and it moves in with time. And so basically, when we talk about skew, a lot of times what we're looking at is where's the belly of the curve versus someplace far below the money. And the steepness of this line, they do become relatively straight. With a day and a half left to go like this isn't perfectly straight. If there wasn't all of this noise going on in the market, we would be straight. But what's happened, and we talk about how steep things get, when people are willing to pay for more protection further below the money than they are at the money, that's when there's more fear that something bad is going to happen. When does that happen the most? Usually when we're running along fat, dumb, and happy, nobody's worried about anything. So the options, okay, are priced at the money very, very low. Don't forget, it was on this day, or maybe I'm a day or two off, but it was near this day where the VIX, at least using its old formula, hit a 23-year low. If you use its new formula, it was only a multi-year low. And so the fact that we've jumped off of these very, very low levels is, we moved 40% and we're still at 15 on the VIX. Not exactly fear and panic mode. And what ended up happening here, I'll just take you through it day by day.
Well, Jim, 15 is the new 20 in the VIX.
Yes, it is. Yes, it is.
20. I think it's the new 30.
So what you can see here, see how the 1 month ended up jumping up, and the 1 month is the area where we focus on the most, okay, on the monthlies. You can see how we ended up jumping up on that day. We moved up higher. Now, when we end up going through the sell-off, okay, like we did yesterday, what happened was that the put skew actually got steeper. Think about what happened. IVs jumped rather dramatically. We would end up considering a jump in IVs to end up being something that's normally associated with the put skew flattening. It didn't flatten, it got steeper. What did that tell you? It tells you that the little sell-off we had was probably not, it was probably an overreaction for the initial announcement. It also ends up telling us that, hey, if the investigation does yield anything negative, it's going to end up getting really, really ugly. Okay. Paul, somebody asked, I don't know, do you have your a skew curve graph that you show sometimes? Do you have that up?
I do.
Can I give you the ball? Let me close this. Let me come over to here. Get the participants. And I got to find you.
You want to borrow my St. Bernard?
I'm going to have to do a find here because I'm paging down and I don't see you.
Jim, I think it would be helpful maybe if you spoke about people who are thinking about putting positions on now. Should they think more in terms of a broken wing or a symmetric butterfly hedged by a call? What position would be better given what's happened in the market?
Yeah, actually, the thing is that there are a couple of questions about that also. Paul, I'm going to do that because I can't find you. I don't know how to end up giving you the ball from here. Anyway, let me
Stop.
answer that
Why don't
question.
you stop sharing, and maybe, and go to the list.
Okay, I'll do that after I answer this question.
Sure.
How does implied volatility and skew affect different trades? What I did, and I'm going to end up putting on one of these for later today, but what I'm going to end up looking at is I look at the following. Let's start with this butterfly. Okay, broken wing butterfly, about halfway up the curve, and what I wanted you to see is what ends up happening with the price. I made the lower wing, okay, slightly longer than the upper wing. It's an SPY graph, so this way anybody can end up playing with this. 4 points on the upper wing, 5 points on the lower wing. Okay, and what I did, just so that you could see this, and I did this because I knew I'd be asked this question. What I did was that I just created all of these butterflies. Each one of these is just 1 point lower. So this has a center strike. Everything is 4 points upper wing, 5 points lower wing. This has a center strike of 235. The next one has a center strike of 234. The next one below that ends up having a strike of 233. You can see the prices and you can see the deltas. Okay, and so what ends up happening, like yesterday, for example, I was looking at this specific butterfly, okay, during the morning before we had a really hard sell-off. I was able to end up buying this butterfly yesterday for 24 cents, okay, in July. Now, I also had butterflies like this that I'd been either had on or was tracking during the June time frame. Now, June's only 1 month out, not 2 months out. What ended up happening with that June butterfly is that we were up in this range, okay, and as we started to end up moving down, remember, as you get closer to expiration, this graph ends up changing, okay? Here's probably the most important thing that you could possibly learn when it comes to how implied volatility affects butterflies. Okay. If implied volatility moves up, okay, it is basically the same thing as the clock going backwards. So what I'm saying is a severe drop in implied volatility. We're not talking about skew yet. Okay, a severe drop in implied volatility is very similar of the way it's going to affect your P&L of your butterfly as if time passes. What does that mean specifically? It means that if I am within the outer legs of my butterfly or the wing tips, okay, of my butterfly, if implied volatility goes down, it means that this portion of our graph will move higher. If implied volatility goes down in this portion of our graph, okay, our P&L will be lower. Okay, it's very important to understand that. So what happens is that when you, and the exact opposite is true. So if implied volatility going down helps your profitability in the center of your butterfly, implied volatility going up will hurt the profitability of your butterfly in the center. So what happened yesterday as we were coming down and my P&L graph, okay, and here, let me just switch this over to June so you can see what it looked like in June instead of me saying theoretical stuff. Right, is it the 16th? I don't know if the 16th or the 21st is, which one is the monthly expiration? 16th? I'll take a look. Yes, 16th. Okay, so what happens is you can see here with a month left to go, notice how much more curved this T plus zero line is versus the July, right? If I go back to July, you see that the July is much flatter and June becomes more curved, right? It's more rounded, okay? The June, if it redraws. I have to do this because it's too slow, okay? And so it becomes more rounded at this point. And so what are we looking at, okay, in this butterfly? Well, yesterday, okay, we came down from, just under the 240 range. And as we moved down, okay, yesterday, this implied volatility line, the pink line, the T plus zero line, was curved much, much higher. As we moved down to this area, at one point, okay, my trade, okay, with 6 contracts was up $100. By the time we closed and we moved further down, which we would have thought, hey, this would have been really good for the butterfly, right? I mean, a T plus zero line saying that I'm going to go up. If you take a look at my deltas were negative. Hey, this should have been really, really good for me. My profits went from $100 on the trade down to 18. Now, most people would scratch their head saying, Jim, I don't get that. How is that possible? Your deltas were negative. You ended up moving to the center of your butterfly. How did you end up losing money? And we closed, by the way, just under the center of the butterfly. I think this might have been the same one. I'm not sure if I have the exact same tracks. We closed just under the center of the butterfly that I had yesterday. How did we end up actually giving back, $90 or $80 of our profits?
The upper long.
It's the upper long. Okay, yes, but what ends up happening is that it's the overall vega of the position. Now, I'm going to break down the position. We can break down it in individual legs. But what ends up happening is that what you don't end up realizing, okay, is that a drop in volatility, okay, ends up playing, right? You guys have a lot of experience. A drop in volatility has helped your butterflies, and you guys have made a lot of money over the last year and a half. You guys haven't seen too many 40% increases in the VIX over the last several years. You had a couple of opportunities, but not a lot. How did that end up affecting it? When you have that level of a jump in volatility, implied volatility, what happens is that your T plus zero line over here is overstated. It will tell you that you'll make more money than you actually will. Okay, if you guys have ever heard me talk about, okay, and kind of joke about the bent motorcycle handlebars, right? When I was 18, I put my motorcycle on its side, I bent my handlebars. Anybody else tried to drive my bike, they'd kill themselves because it's like, your bike makes a severe turn to the right. Yeah, I know it does. It's because I bent my handlebars. I know that it's bent, and I know which way to end up going. Well, I've been riding, okay, a motorcycle for a long time, and I've been trading options for a long time. I know that my motorcycle T plus zero handlebar line right here is bent. I know that when implied volatility is low and I'm above my butterfly and I come into my butterfly, I know whatever profits, the machine says I'm going to end up making is pretty much a lie. And I know that my profits are going to be much, much lower. Point in case, what's the worst one that ever happened to me? The Thursday before Mother's Day and the players, okay, what was it, 5 years ago when Greece looked like they were going to end up going under and the euro was having problems, I had a symmetrical rut butterfly that I put on well below the money. During this incredible drop that we had during the day, at one point I hit the center of my butterfly. I should have been, I opened up my Thinkorswim thinking I was going to be up a ton of money. I was flat. What happened? For every delta dollar I was able to end up making on the way down, because my deltas were negative and I should have been making all of this money, for every delta dollar that I was making on the way down, my Vega dollars were going, as the delta dollars were coming in the front door, the Vega dollars were going out the back door. I didn't make any money at all on it. Okay. Volatility plays a severe role in your P&L, and you have to understand how volatility, not just the change in volatility, but the change in skew, will affect the pricing of whatever your whatever your trade is. This is why, and I know I've talked to Paul, we feel so strongly that the people who end up, chasing the trade du jour, oh, let's go try to learn this and let's go try to. If you don't understand how implied volatility is going to affect that trade, go to Las Vegas. I mean, that's basically what you're doing. I mean, you have no concept of what's going to end up happening, what's going to end up helping. If you and here's one of the ones that really, is one of my pet peeves. Sometimes people don't care, okay, why they've made money. You make a bunch of money on a trade because volatility's changed. You better understand why, because next time it may not move in your favor. Matter of fact, most of the times it won't move in your favor. It's going to end up moving against you. And so this way you understand why you're making money or you're losing money. The volatility ends up playing a huge role in that. This is butterflies. I've talked about butterflies because I know most of you trade butterflies. I will end up telling you that the study that you have to make for yourself is the distance of the wings. Okay, one of the reasons why my longer term, Kevlars, or just meaning a month out, they didn't get hurt. Okay, in this drop is because one, you learn over time that if you're going to have trades that are going to be short Vega, you have to realize that a delta of 0 is not a market neutral trade. Because if you have a delta of 0 and negative gamma and negative Vega, as you move down, okay, the gamma and the Vega will end up making the delta worse. Well, the gamma will make the delta worse, and the Vega will end up killing you because implied volatility goes down. There's a reason. If you guys have heard me say this before, every butt kicking I've ever taken in my life in the options market, the two thugs that have beat me up were gamma and Vega. And what I mean, okay, specifically in here, is that as I ended up going into my butterfly and out the back side of it, what ends up happening is the gamma is going to end up making this worse and worse and worse, and Vega isn't going to start to help me until someplace down here, right? If I end up mapping out my Vega, let's just do that real quick. Okay, and let me do, instead of, let me map out Vega. Take a look at where Vega is today. Vega doesn't help me until we get below 225, right? That's when Vega is going to start to help me. At 225, I'm already in a world of hurt. I'm already outside my butterfly completely. Okay, so people think that Vega, butterflies are negative Vega trades, and they are when you're inside the butterfly. Now, what happens when you're way down here? Well, down here, okay, Vega can only help you, right? Because, I mean, Vega, if it goes up, it means you won't lose as much. But it also means that if you come back in, right, if we go down to, say, 220, as you make the bounce back from 220 up to 225, volatility is probably going to go down. You're going to be long Vega at that point. It's going to hurt you. And so you have to be aware of your environment. The other thing, another pet peeve of mine, is people like to end up having rules and not look at their surroundings. Okay, you have to end up realizing that rules that you're going to end up using are going to be different, not just by price of where you are, but the other factors, okay, that are going to change is that your rules probably have to change with time. Because as you saw it when I mapped out Vega, over here, as I mapped out Vega, you can see that the Vega lines change pretty significantly with each passing week and change pretty dramatically as you get close to expiration. but so does your gamma end up changing. So you have to end up realizing how your trades will morph. Bottom line that I want you to walk away from. Okay, let me do the expiration graph. Okay. When you're inside of the butterfly, right, or the tent or pyramid, as some people call it, when you're inside of this, okay, volatility increases will hurt your pricing. Volatility drops or decrease in volatility will end up helping your pricing and your profitability. Volatility will not help your butterfly until you are pretty well out of the butterfly, depending on how much time is left. By the time volatility is helping you in a butterfly, your trade's probably already dead. Okay. Questions about that, because that's one of the ones that I really want people to end up understanding, because it'll end up helping your trading very, very much. Any questions, thoughts, Paul? I mean, I know. We've been together sometimes, or at least a couple of times when I've gotten my butt kicked, and you've gotten your butt kicked also. Anything you want to add to that?
No, I agree that it goes beyond having a set of rules and guidelines and looking at the environment at this point, versus I put a trade on it at 59 DT or 45 DT or whatever it is, and this is my plan and this is what I do. I'm not sure that's working at the moment. I think you have to be more subjective as to when you put trades on, rather than just follow a set of guidelines blindly.
I agree. I agree totally. Paul, we're just about at an hour, but I've given you the ball. I'd like you to end up, if you could share, because a couple of people have asked, if you could share your put skew graph that you end up generating. Thank you.
See my screen. Okay.
Oh, but by the way, because I know that Paul had a Jeep type structure on there. Jeeps or iron condors, some people call them weirdos also, volatility will hurt them more than a butterfly. Mm-hmm. Okay. The two things that you have to end up realizing is that the wider the body of your condor, and all a condor is that your center strikes are split. So the wider the split between your two upper short strikes, or your two middle short strikes, however you want to look at the shape of a condor, and the longer your wing lengths, those are the two factors that will make volatility hurt the pricing of your structure more. Paul, some people may not have seen this before, so would you just explain real quick what we're looking at?
Sure. This is basically what this does is this compares the skew curve to the past. So right now, I have the data downloaded to April 28th. You can see it here. And it looks at the previous 15 trading days. So we're looking from April 6th to the 28th for the historic data. And then the red line here is today. So I get to see, in comparison to what's gone on in the past, what the skew today looks like.
These
and
are
that helps
on the
me.
same expiration, Paul?
Yeah, what it does is I pick June, so it's June is 29 DTE, and so it goes out and looks at this June expiration. And this is all the same expiration. So it's just tracking the June as it's moved forward. And you can see here, these are the DTEs that in the past. So until I update the data, which I probably will do today or tomorrow, you're looking at a 49 DTE. So naturally, as time goes on, it gets a little steeper just because of the time frame. But it just gives me an idea of going back what environment I was trading, had to deal with in this environment versus what I'm trading today. So yesterday, this thing, it didn't, actually was a little steeper, and the whole thing was up here somewhere, but it never flattened out like this.
Which many times when fear is starting to be realized, it flattens out.
Right.
And so the jump said that jump in volatility, drop in the market said, we haven't even begun to think about, okay, how bad the sell-off could be if it gets realized.
Right. Somebody asked about looking at the butterfly pricing. I can show it, but I tried to update it this morning. I think I have too much stuff running because it didn't want to update. So we can look at it from what it looked like yesterday on this particular. This one. Not going to give us, because this is not at the money anymore. This is much lower. Yeah, what I'll do is I'll move it over and see if I can get it to update while we're chatting. Probably close this. We'll wait and see for that.
Butterfly prices were very high earlier in the week, and they came in dramatically yesterday.
Yes, they did. And they're still low today by the look of it. Let's take a look. Any particular month you want to look at? Because what I have up here is a 35. Let's go out to July. And find a 56 DTE, and where are we trading?
July, which is 60-something days, was very expensive on Monday.
Yeah, they came in yesterday. I actually put a trade on yesterday. It's an M3-ish style trade because the prices got down low. Trying to see if that actually makes a difference. Okay, so here it is. So this is a July 14, 56 DTE trade with the 25 points below the money. And it's a 50-point wide. So you can see this is dramatically changed from what we were seeing before when these red lines were up in here.
Mm-hmm. I put on my July Kevlar yesterday. Yeah. Because the pricing was so good.
So, and it depends. Now, if you look at the history for these past few years, this isn't that great a price. But if you look beyond that, historically, you see that this is a great price. So this is something that, I would consider a decent day to put something on. Because if the skew gets steeper down at the belly of the curve, you're fairly safe because the price of this fly will go up.
But it also depends on what you put on. Personally, I'd be more comfortable putting on a call-hedged butterfly than a broken wing, only because there's quite a bit of ambiguity about how much and in which direction the market's going to move. If I thought we were closer to a bottom, I'd feel more comfortable with a broken wing.
So I'm going to move this over and
I don't know,
calculate
Jim.
out.
What structure did you use for the Kevlar?
I used a normal structure. What I had been using, what I was all set to end up using is I was going to end up using a call butterfly slightly above the money. That's what I was going to end up putting on before we had the huge sell-off. Okay. IVs were low. I wouldn't have made it broken wing. It would have protected the downside. I would have had limited loss. I could have added more to the downside. But after the vols went up, even though put skews remained steep, what I ended up doing is that when IVs, and here's another thing that affects butterflies, when IVs are very steep, the put skew steep, you're better off using a narrower structure. Okay, so I love really long wings. Okay, when IV's a little bit higher, okay, you have it's a great trade. But when IVs get to be very low, you and put skew gets to be very steep, you don't want that steepness to work against you. The wider you make your butterflies, or the wider you make the center of your iron condor, right, the more risk that you end up having in play. So I used my structure, but it was much narrower than normal.
Okay, so there's a question here on the vertical scale. I assume you're talking about this right here, and this is the pricing of the butterflies. So the blue line in here are actual butterfly prices historically. So like you can see up here, this is from July 22nd of 2011, and the value of this butterfly on that date. So this blue line tracks the date, the butterfly pricing by date. The black lines are one standard deviation away from the average. This is the average price, and the red line is today. And I just went and redid the skew calculator. So this is the call side. So, while I've had a couple of occasions where the put pricing was really pretty good, and I went to put on a trade, and I trade with long, calls. I do more at the money calls right in this area rather than deep in the money. And I looked at this, and then I went in the database and pulled up historic pricing of that particular call, based on, it was, I think, 20 points in the money. And I found out that on the day that I would have put my M3 type trade on, while the put fly was priced correct, I was paying $5 more than the average for the call. So I didn't put the trade on. That's a big drag. The call can become a big drag on the trade.
Well, that's the problem now, isn't it?
Yeah.
Not the volatility went up, but with the skew getting steeper, that deep in the money call got more expensive, more time premium.
Right. You could see it here today, right? Because here's the deep in the money call is up in this area, and this was back in historic. What was that? Was 427. So let's. So that's the difference in the call skews between 427 and today.
I think if you want to hedge an M3 right now, I think you're obligated to use a weekly call rather than the monthly.
Possibly. So let's look at, that's 8 days, 15 days. I don't know how long this is going to take. Let's see. Or if it'll work. coding is not my profession. Nope, didn't like that.
One of the things that and I love Paul's tool, and I call him up and we talk about it, and I have access to institutional level tools also. You get a feel for, hey, implied volatility as it moves up. As I told you, it's going to hurt me here, it's going to help me there. So realizing, okay, that where you're buying or selling your specific options in whatever trade structure you use, you have to realize, hey, when IVs go up, here's how it's going to end up hurting things. Here's how it's going to end up helping things.
Yeah, I'm having a hard time getting the call site this close in.
Okay, let's see if there are any other questions. Yeah, Rakesh made a comment that one of the reasons why butterflies above the money, okay, in calls work so well is that when IVs get crushed, that's like a double whammy. For that reason, call butterflies above the money are significantly more expensive than put butterflies below the money because of that exact reason in the skew. Yes, they work well and you make money, but you're not going. It's not like it's a free lunch. You're going to make a lot less money than you would if the put butterfly worked. Okay. That's it for questions. Any other questions that people either want to write in, or any final comments from anybody who's on the call? Andrew, anything? Paul and I have been going. Any last comments you'd like to end up making, or what you're trading?
Right now, I have nothing on except some SPX debit spreads that I bought. I'm actually looking to put a July position on, and okay. I've just been debating exactly what to put on, and I think I kind of like an M3 structure with a weekly call. I think that gives them the most flexibility right now, because with that weekly call, you're buying much lower down on the curve.
And you don't have as much risk. And if you don't need to hedge your Vega, that makes sense. The only reason I don't use weekly calls is because the thing is that I'm not only looking at, for my long call, when I'm using my mode 1 in my Kevlar, is that I'm also looking at it to hedge my Vega. When Vega's already high, it doesn't need to be hedged. Okay, and so using a weekly, when IV's high, I wouldn't use my Kevlar M1 style, which is a butterfly with an extra call. Very different rules and management style than an M3, but if you looked at the graph, you'd find that my call is much closer to the money. When IV gets high like this, I'd rather use broken wings. If I was going to end up being forced to end up trading my mode 1, meaning a butterfly with a long call, when IV's high like this, using weeklies is probably the best time to do it.
I know if I had a position on and the market went down, the SPX got down to that 2320, 2330 area, and I had to roll down, I would probably roll down into a broken wing, because that's probably a good area of support, and we're likely to see a pretty strong bounce from there. And at that point, I'd rather be in a broken wing.
Right. That all makes sense. With that, I'm going to end up calling, because we are over at this point. As for hedging trades going into yesterday, right? I didn't want to do that today because we were talking on the Monday Market Muse. I had on a call vertical on the VIX. Yesterday, I converted that into a condor. I'll be reviewing that trade on Monday at 10 a.m. Monday Market Muse. So if you can attend, I'd love to see you there. Thank you, Paul. Thank you, Andrew. Thank you for everyone with your questions and attending. And I hope everybody's gotten through this little sell-off that we've had relatively unscathed. Thanks. Have a great day.